right. Hey, welcome everybody. Great to get together for another, I think this is the 14th session of Veteran ETA Roundtable. Thanks to all the new folks in the group. Also good to see some familiar faces. Veteran ETA, as many of you know, is just a group to get together to kind of learn about ETA and support each other in the community. So definitely recommend getting on the Slack channel if you're not. A lot of good information shared and, good ways to connect with everyone, and everything's, free, no solicitation. So it's just a good place to get together and help fellow veterans out with ETA. Really excited tonight to have Matthias Smith of Pioneer Capital Advisory with us. He's going to be kind of talking about the SBA lending process and kind of some of the things that he offers. Firsthand, I know some folks that have worked with him directly. It's been a terrific experience for them. I'm excited for him to both explain, some conceptual stuff with the SBA, but also kind of speak to kind of what he does at Pioneer Capital and how that can, be a really win-win situation for a lot of folks going through ETA for the first time. But a quick little background on Matthias. So he's the president and founder of Pioneer Capital Advisory, which is a company dedicated to helping business owners and searchers navigate all aspects of the SBA loan process from start to finish. With the passion of empowering entrepreneurs, Matthias, he brings just a ton of experience and expertise to his role. Prior in the last 7 years, he worked at some of the nation's largest volume SBA lenders, including Byline Bank and Live Oak, where he specialized in closing SBA loans. His extensive experience spans a diverse range of financing deals across the nation, from self-storage, ground-up construction prospects in Alaska to private equity platforms, add-on acquisitions. I mean, he's done a ton of different deals, has just a wealth of knowledge and experience. And Matthias founded Pioneer Capital in May 2022. I think I was listening to some of your podcasts. I know he's very prevalent and well-known in Twitter, and you've been on some big podcasts. I think you did 50 million 2023. I think you're on pace to do 100 million this year in deal volume. So, I mean, he's just seen a ton of deals. He's a wealth of knowledge. And then personally, as kind of a young lawyer and just connecting with him for some folks, some buddies of mine that are going through this, he's incredibly accessible for how busy he is, and very, very passionate about helping veterans. I know he's worked with a ton of veterans. So I'm thrilled to be able to connect with him tonight and have him on. And I'm going to stop talking because I want to use all this time to have Matthias share some good insights. So thanks again, Matthias.
Yeah, of course. Well, yeah, first and foremost, Charlie, appreciate you having me on here. Great to be here with your group and meet everyone. Definitely glad to kind of share what I do, answer any and all questions related to SBA financing, and just, I guess, anything about the search, acquisition, financing process that I can help kind of shed some color on. So maybe just to dive in here, I don't know if you want to go to, let's go to the second slide and we can skip over to 3. Yeah, so this was left slide, just kind of real quick. This was back in the spring. Got invited by Dominic Blue to talk at USC to the veteran MBA class there. Phenomenal experience. Got to meet some pretty awesome people. Dominic himself, I did not work with, but he was on the Acquiring Minds podcast, I believe. And then Samil Jarwal in the middle there. He does mostly traditional search financing. And then on the right side there, just 2 friends, Eric with S&B Law Group. Now, you guys have probably seen him around Twitter and LinkedIn before. And then Chris Barrett with Midwest CPA. Let's go to the third slide here. So just kind of super high level background in what I do. So Pioneer Capital Advisory, I started back in 2022 or May of 2022 after working for about 7 years at 4 different SBA banks. So was at Live Oak Bank for half a year back in 2021, working in their search fund lending and specialty finance division. So working on search fund deals as a closer, and also upmarket independent sponsor, private equity kind of buyer type profile deals. Was at Byline for 3.5 years, working on deals ranging from business acquisitions to ground up new construction, building purchases, debt refinances, everything across the board. And then 2 other banks based in Wisconsin. So just to kind of jump in and tell you what I do. So in the SBA lending space, more or less, you have all these different banks out there that finance SBA loans. So you have Live Oak Bank, which many of you have probably heard before. They're the top SBA lender in the country. You have Huntington Bank, Byline Bank, First Bank of the Lake, Bruce Marks, huge veteran SBA lender, and then many other banks as well. And so each of these banks has their own fundamentally different, unique credit box of the types of deals that they want to finance based on a compilation of factors, including buyer background. So is it someone that's coming from industry experience buying the business? For example, master technician buying an HVAC company. Is it a first-time searcher buyer, someone that's never worked in the industry before? What is the leverage that you as the buyer are looking for on the specific deal? So some banks don't like to go more than 80% financing on deals. Other banks that are kind of more risky from a lending standpoint will go up to 90% with no seller notes justified. And then banks have their own debt service coverage requirements too, for what they want to see as far as the free cash flow over and above bank loan payments plus seller note payments. So essentially what Pioneer Capital Advisory does is I help business buyers find which bank or which kind of subset banks in the SBA lending space are going to be most closely aligned with their deal based on those underlying factors. So if it's a more conservatively structured deal, is it, a deal for Huntington or Live Oak or similar? Or if it's a more aggressive type deal, is it fit for like a byline for a certain bank or kind of one of the more flexible SBA banks? So I think that kind of covers most of this slide here. We could go to the next one. Go back to this one here. So basically, Kev, to give like a high level overview of the process of Pioneer Capital Advisory. So the way that I work is I get involved on a deal at the time that the searcher or buyer is either under signed letter of intent or close to signed LOI. So basically, close to signed LOI would mean what it sounds like. You have a listing or an opportunity that you're looking at. You've had some communication with the listing broker. So for example, you've kind of talked about what the purchase price might be or the offer price, seller financing amount, general terms, things of that nature. And basically, you feel pretty much closely aligned on the deal. And so essentially what that looks like is a searcher will reach out to me, hey, Matthias, I'm looking at this HVAC acquisition, $2.5 million potential purchase price, 10% seller financing, the seller note will be amortized over 10 years. Maybe there's going to be a balloon after 4 years or 5 years. And then I'm going to come to the deal at 10% down, all cash. And here's my spreadsheet model showing what I'm modeling for debt service coverage. So then the way it would work is I would sign a mutual NDA with the searcher or the buyer to establish confidentiality, to basically acknowledge that anything shared directly with me will be kept confidential, only shared directly with the specific SBA bank or banks I'm reaching out to get financing proposals, and specific parties that the buyer would authorize, such as the M&A attorney, financial due diligence provider, etc. And at that point, the searcher or buyer would share with me the listing for the business and whatever financials they have. And then we would hop on a Zoom call to kind of vet the deal out together. And so I would basically give my candid feedback based on the structure of this deal. This is something that's structured in a way that's SBA eligible. It's likely going to get good financing terms, or there are things missing from the uses of funds, specifically the loan budget, like maybe the buyer is missing working capital, closing costs, there are M&A attorney fee, things of that nature. And at that point, Kev, depending on what my opinion is of the deal, Kev, my level of conviction, I'll pull in one of the lenders that I think will resonate closely with the deal to basically have them vet it out and give their thumbs up on the specific transaction. So like, say hypothetically, I think the business or the deal is a fit for Huntington Bank. I'd pull the lender in there to have them kind of go through the deal together with me and the buyer to give their thumbs up and validation of the deal structure, and basically having the lender issue the equivalent of a term sheet that the buyer has to submit with the offer to strengthen the likelihood of acceptance of the LOI. So that's, I think that kind of covers this slide here. Yeah, let's go to the next one. So this is just kind of high level overview of deals closed and starting Pioneer. So the year that I started back in 2022, closed only 6 deals since I was only in operation for half a year, middle of May of 2022 through December. Last year closed 22 deals, and this year to date, I've closed 25 deals, and I'm hoping to hit at least 40. So this just kind of shows growth year over year and representative sample of transaction volume that we've worked on. So the purpose of this slide here, so a number of clients I've worked with have been veterans, so people that you guys may have heard of either through groups like this or on some of the podcasts like Acquiring Minds. So I worked on Nick Wheeler's acquisition that he closed earlier this year. Worked with Nathan Linehan, who bought an HVAC business to add onto his platform, Bart's HVAC in Dallas, Texas. And so these are just kind of screen snippets from the Acquiring Minds podcast to give some texture, as well as Nick's Google review. Let's go to the next slide after this one here. So this kind of covers why buy a small to medium-sized business versus why go down this path kind of as a buyer. So these are just kind of some high-level data points. So most jobs or most businesses in the country are small businesses. So being a small business owner gives you a tremendous impact to form kind of, the economic vitality within your community, and basically kind of helping to spur job growth, providing professional and kind of financial benefits to both, yourself and people in your community. It's very fulfilling to have control over your professional and financial destiny. So whereas when you're a W-2 employee, you're working in corporate America and you're at the whim of whatever your company decides to do, as a business owner, you're very much kind of in control, and you hopefully have autonomy over your destiny. And as a small business owner, the success and failure of your company ultimately kind of hinges very much on yourself. And so then these bottom 2 bullet points is kind of more of a comparison between the traditional search versus self-funded search. So self-funded search or SBA-funded search, there is a personal guarantee required from anyone involved in the ownership group that has 20% or more ownership of the business. Some banks are fine with as little as 1/10 of the down payment. So you always have to have 10% equity injection, which just means down payment, coming from the buyer or coming from the operator of the business. And basically it's a lot more, you have a lot more autonomy doing self-funded search versus traditional search, due to the fact that you as the buyer have control over what deal you want to do. And unless most of your kind of funding sources hinge on equity raise, you're the one that ultimately gets to pick your deal. So that's the purpose of the last part of the slide there. Let's go to the next one here. So this kind of covers just super high level overview on self-funded search. So when you're buying a business using SBA financing, the equity in the business for you as the buyer, it's established at the time of closing. You as a searcher are the one that finds the deal. You determine if the deal is a fit for you and your skill set. Almost always, the searcher will own the majority of the common equity. And then if you're doing an equity raise, the investors will normally own the preferred equity can get split differently. The searcher retains most of the economics or ownership for the business. There are lots of banks that will finance buyers looking to use SBA 7A financing for acquisitions. And then the searcher is ultimately the one that's in the driver's seat from an operational decision-making standpoint. So this slide basically, the purpose of this is to explain that if you're using SBA financing to buy a business as a searcher, There are lots of investors out there that will put capital into these deals. You have autonomy as far as how you want to operate the business. You don't have, typically speaking, not always, you don't have a board of people where they're kind of telling you what to do. So there's a lot more latitude going down this path versus going the traditional path. Let's skip to the next slide here. So this is just kind of super high level on SBA financing kind of metrics and things that are required. So the banks underwrite deals off of what's called debt service coverage. So basically they're looking at the seller's discretionary earnings or the EBITDA of the business plus the add backs. So like owner's comp or seller's comp minus what your new comp would be as the buyer, personal expenses and one-time expenses that have been run through the company that won't be recurring post-acquisition. So that's going to be the numerator, the top part of the equation. And then the denominator is going to be whatever the annual SBA loan payments would be, plus the seller note payments. And so with SBA financing, the minimum requirement is that you always have to have what's called 1.15 debt service coverage, meaning 15% cash flow over and above bank loan payments plus seller note payments. Now, most banks, as many of you who are probably currently looking at deals or modeling deals, might be looking at this slide and thinking like this is super low. That's absolutely correct. Most banks, currently speaking, require at least 1.3 debt service coverage. The more conservative ones that will give good financing terms want to see at least 1.5. I'm telling people currently aim for at least 1.3 for the trailing 12-month period in addition to last year. And if you're planning to work with one of the more conservative banks, aim for 1.5. So after this slide, I think it's mostly just have some additional information from a process standpoint. But this, so basically this kind of covers a time frame with going through the SBA financing process. So generally speaking, it's going to take somewhere in the order of 10 weeks to 90 days if you're buying a business that has no commercial real estate involved. So the way this process or kind of time frame shakes out, generally speaking, is from the time that you have everything needed to start underwriting, all of the financials for the business that you're buying, last 3 years of business tax returns, current year-to-date balance sheet and profit and loss statement, your personal financial statement as the buyer, your resume, your last 3 years of personal tax returns, your source and use model showing what you're looking for as far as working capital, transaction costs, what your attorney fee is expected to be, financial due diligence costs, SBA guarantee fee, and then also showing kind of what you're looking for as far as the SBA loan amount, the seller note amount, and then your capital plus investor capital into the deal. So from the time that you have all of that in addition to the acquisition business plan, the projection, that's right around when underwriting will commence. And so depending on the bank, this is kind of where there's some nuance. Every bank takes a different amount of time to go through underwriting. And some banks have a backlog. So basically, once you have everything needed to start underwriting, you have to wait in a queue depending on how busy the bank is. So the faster banks will take somewhere on the order of 2 weeks to go through the process start to finish from commencement of underwriting through to approval. So banks like First Bank of the Lake or banks like Huntington will move fast. Some of the other banks, I won't name specific names, will move slower. And it might take up to a month to get approved, and you might have a backlog where you're waiting in a queue. So, for example, a couple of the larger SBA banks this past summer, there have been deals where it's taken 3 to 4 weeks to get into the underwriting queue from the time a client say complete file. So the 10 weeks, basically that time clock starts at the onset of underwriting. And then from there, I tell clients to anticipate about up to 4 weeks to get to an approval, and then another 4 weeks for the post-approval items, which entails getting the purchase agreement done, getting corporate documentation done if it's not done before approval, getting down payment documentation from yourself as a sponsor or buyer, as well as investors if you're doing an equity raise or a capital raise, getting your life insurance done, business insurance documentation, lease agreements, landlord agreements, business licensing, all of that. And so basically, up to 4 weeks in underwriting, up to 4 weeks post-approval, and then the tail end, the way that you get from 8 weeks to 10 weeks is what I call the shit happens buffer, kind of in air quotes. So on some of these deals, unfortunately, what happens is the closer might take a surprise vacation while you're post-approval. So like they might be gone at the tail end of the process. The seller attorney might lock horns with your buy-side attorney on getting the purchase agreement done. Sometimes surprises come up in post-approval due diligence. So the bank will order their own lien searches on the seller, and sometimes UCC filings or tax liens and things like that can come up. So on the longer end, I typically tell people plan for 90 days longer end, but anticipate somewhere around 10 weeks if things go smoothly. Second point in this slide is going through the SBA process. Unfortunately, with it being a government guaranteed loan, there's going to be a ton of paperwork. There's just no way around it. And so outside of all the financial statements, personal financials, business plan, all of that, there's going to be lots of miscellaneous paperwork that you have to fill out for the bank. So things like the SBA More Information Form, landlord subordination agreements, documents listing the officers of the business. Basically, plan for a paperwork intensive process. Regardless of if you're working with a really stellar bank, it's just going to be part of the process. So some people don't like going through all the paperwork minutia, but just know what you're getting into if you ultimately decide to go down this path. And then the last kind of point on this slides here specifically is that, and this kind of interlinks with the second point, is lots of these closers at these top banks, like the Bylines, Live Oaks, and similar, might have 10 to 12 different deals that they're working on at once. And so sometimes what happens when you're going through this SBA process is you might have to send a driver's license 2 or 3 different times because they'll delete the email or they'll archive it or they'll overlook it. And some people that I've worked with get super agitated about that, which is completely understandable. But just plan that at times, if you do go through this SBA process, regardless of if you're working with the best bank and a really capable lender and team there is going to be headaches and obstacles and kind of frustration points like this that will come up along the way. I think that's everything for this slide here. So this slide here, so this kind of talks about when Pioneer gets involved in a deal. So when I get involved in a deal, Kev, as I was mentioning towards the start of the presentation, it would be when you as the client or the buyer is either under signed LOI or close to signed LOI. And basically you kind of know this is the structure that you're planning to transact on. Contemplated purchase price, seller financing if applicable, equity amount, you have the deal modeled out in a spreadsheet. And basically there's been some dialogue with the sell side of the deal, typically the broker, because most of the times the broker won't put you in direct communication with the seller until after you're under LOI. Because until you as the client know what you're contemplating to offer for the deal in the underlying structure, there's not a whole lot that either myself or even a lender directly can do to give feedback on the deal. So like I could look at a broker listing and say, this looks like a company that has very unstable earnings, or it looks like it's priced super high. But having the structure fleshed out on a spreadsheet with how you're thinking about it and knowing that there's buy-in somewhat from the sell side of the deal helps make it a more valuable and productive discussion at the time that we connect. The second point here, I think we covered this, just talks about signing mutual NDA. And then the last couple of points here, so this is just explaining that once the NDA would get signed, we'd hop on a Zoom call, talk through the deal together for me to give my candid feedback. If I think the deal is SBA eligible, and structure a way that's going to get good financing terms from the banks. And the fourth bullet point here that's to kind of convey, as far as how I make the decision on which banks to pitch the deal to, it's a combination of factors, including which ones will move the fastest in the process and which ones are also going to give the best financing terms for the deal. So, for example, if you have a really really highly leveraged deal, let's say 90% LTV, and you're planning to have only half of the down payment come from cash, and you're planning to use a seller's note onto your standby for the other half of the down payment, and let's say your debt service coverage is at the rock bottom of as 1.15, there are banks that will finance that deal, but it's going to be prime plus 275 most likely. If you have a really good deal, let's say you're at 75% bank financing, 10% or 15% cash equity, 1.5 debt service coverage, there are banks I work with that will go down to prime fixed for 2 or 3 years, or like 9% fixed for 3 years, and then 175 over prime variable. So that's what the last or fourth bullet point is to convey, is kind of how I assess what banks to pitch a deal to. We can go to the next slide, I think, here. Yeah, so then this is basically, this is just how to get in touch with me. So email, contact information, or if you have a deal and you want to book a call to connect. That's everything I have as far as the presentation. Hopefully I didn't do a crappy job.
No, that was terrific, man. Thanks so much. Yeah, that was great. And I'll definitely share all that information for people to get in touch. I guess right now I think it'd be a good time to open up, some Q&A. Feel free to, ask any questions, pop on the screen, or also you can chat and I can kind of moderate. But if anyone has a question, please fire away to Matthias. And if not, you'll have to listen to me ask you lots of questions, which is probably not as good. But
glad to answer anything and everything. The last one of these I did was back in March of last year at Warden. So I cherry picked pieces of that deck that I did last year because I threw this together at 11 p.m. last night. So my presentation skills are a little bit rusty, but hopefully it was somewhat decent.
I think Travis, you're on mute. Yeah. If you have a question.
Yeah, looks like he's on mute.
No worries. I guess I can start off, Matthias, with a quick question here. What kind of things are you seeing from guys who are doing this for the first time, that some pitfalls to kind of avoid, as far as, when to engage the lender, when to engage you, when to, just kind of things to kind of look out for as someone that's, seeing a ton of deals and work through a lot of this?
Yeah, the honest thing I would say is to not start incurring costs for a deal until you've done substantial pre-LOI diligence. So I'll give you an example, Charlie. There's a searcher that's been searching for about the last year, and basically right now he's kind of getting desperate to get a deal done because the amount of funds that he has to use for down payment are pretty much just drying up. And so he's doing seller visits and taking trips to visit sellers just because he's excited about deals, where he hasn't really done a full assessment to crunch through all the numbers, get questions answered on add backs, things like that. And so what I tell people essentially is, before you submit an LOI or an IOI, try to get your hands on as much information as you can to validate the deal structure, get questions answered on add backs, questions like how involved the sellers in the business, anything and everything like that. And so pretty much the guidance I would give, or the first point, is try to, before you start incurring costs, getting an attorney involved, getting a financial due diligence provider involved, is try to do as much assessment as you can on your own, just to ask the initial questions of the broker that you think are important, if that helps. So things like working capital, or what does the seller do in the business? Why are they adding back the spouse's salary? Is the spouse actually involved? Questions on licensing, things like that. Try to really probe as deep as you can before submitting an LOI so that you can get those questions answered so that you're comfortable before you start incurring those costs with professionals. That would be one piece of advice. Another piece of advice, which stems from some recent deals that have gotten done, is to the degree possible, before you submit an LOI, especially if you're dealing with a business that has a pretty big working capital need, is try to get some type of indication as to what normalized working capital will likely need to be. Because sometimes what happens is when people write the LOI saying buyer and seller will agree on a normalized target level of working capital that will be established in financial due diligence, if you're the seller, you're going to be thinking in your mind, I'm going to leave the least amount of cash and AR in this business as possible. And so when the QV comes back and it's a huge number that's asked for to be left of the working capital, that can sometimes torpedo deals. And I've seen that happen a handful of times.
Great. Thank you so much. That was very informative. I think we got a question from Harold. Saw your hand raised.
Yeah, no. Hey, Matthias, this is great. I also pretty sure I follow you on Twitter, and you always have some good stuff there too. So I appreciate it. I think one of the challenges is as you take a look, and I've done some sort of pre-LOIs, and I've done LOIs, and then they come back and they're like, hey, we wanted another bidder. Then essentially 6 months later, they want to come back and say, well, that fell through. And then anytime I've said, great, send me updated numbers, then it's like silence. And so it's, how do you sort of push through that sort of challenge of, I just find it fascinating that people seem to think, and I understand it, right? You're a small business. You haven't really been using QuickBooks or whatever, and then you've kind of got, for lack of a better term, all liquored up and excited about selling your business. And so you got really diligent, and then you didn't do anything. And now 6 months later, the deal's falling through, and you don't want to go through that pain again. But how do you sort of push those folks to say, hey, the business I wanted to submit an LOI on 6 months ago, is this even the same business now?
Yeah, so the question, if I understand,
does that make sense?
Yeah, so let me just throw the question back to make sure I'm tracking with it. So the question, as I understand it, is if you're looking at a deal and the deal falls through, whether it be with you or a different buyer, and it comes back to market, how do you get the broker and or seller to give you the updated information that's satisfactory, more or less?
Yeah.
Yeah, so I would say just in general, the way that I would kind of socialize with the broker, and I would use the broker as the bad cop, because to your point, some of the small business owners, they've never gone through this process before. So hopefully I have a good broker. Is I would just explain to the broker, as part of the M&A or business acquisition financing process, whether you're using SBA financing or otherwise, the lender is going to need current recent financial statements within the last couple of months. And unless you have those as a buyer, you can't make an assessment on what the current state of the business is from a financial standpoint. So you can't decide on what the valuation is, because as you mentioned, Harold, you could be buying a fundamentally different business than a year ago. Things could go down. They could have lost a major customer. They could have lost a major contract. And so you could be looking at 3 times multiple versus a 4 times multiple, or just a completely different business altogether.
No, that's helpful.
Thanks so much, Matthias. All right, we got a question. I think Austin kind of answered it, but I'll ask it anyways. Is the DSCR on the total debt stack or just SBA portion? And 2, is there a thumb rule for what we should use at the interest rate?
Yes, the DSCR, it's going to be the total debt stack, and assuming the line of credit's fully drawn, as Austin mentioned in the comments there. What I tell people is if you're looking at a deal where the DSCR, and I know it's kind of a chicken and egg because you use the interest rate to come up with the DSCR, right? So you kind of have to know what that is. I tell people use prime 2.25 as like worst case scenario, assuming it's a deal with healthy earnings and at least 1.25 DSCR for the current year to date period in the last year. And if you're looking at no more than say 80% bank financing, if you're looking at something where it's closer to 90% or 85% bank financing, and if the DSCR in the last year you have a filed tax return and or the current year to date period is about 115, then go prime 2.5 or prime 275.
Great.
And there are banks that will do, as Austin knows, because I've talked to them on and off, there are banks that are more competitive than that. But I tell people from a modeling standpoint, if you worst case it or if you use terms like that, if you get better terms, it just improves the DSCR further.
Great. Thank you so much. I get a question from Paul. How much pre-approval work with an SBA bank should be done pre-LOI?
Yeah, so there what I tell people is so twofold. So one, it depends on how much competition there is on the deal and how fast you feel like you need to move. So like if you can kind of punt and put some contingencies in your LOI for more diligence after you go under LOI. So if let's say you're chasing an HVAC business in Orlando, Florida, or in Dallas, Texas, doing $1 million of earnings, you're going to have 20 searchers, people like yourself and others chasing after it. So you're going to have as much time to do as satisfactory pre-LOI diligence as you'd want. So you kind of have to feel out the room and get a sense from the broker to the degree that you can, how much time do you actually have to do an assessment and really kind of go below the hood of this business. But generally what I tell people is as much as you're able to before actually signing the LOI to get the seller tax returns, if you are able to obtain them post LOI. So I would say do as much as you can to get the bank comfortable with the deal, just in principle, knowing that there will be new information that comes up post LOI. And one thing I tell people too, because I've seen this come up on a number of deals recently, Charlie, is ask the broker candidly, are the P&L statements and the tax returns, which you probably won't get your hands on until post LOI, on the same accounting method? So like, are they both accrual or are they both cash basis? Or are you dealing with a situation where you're going to find out after you submit the LOI that you have cash basis tax returns and accrual P&Ls? I can't tell you guys how many times I've seen this come up where a searcher is working with P&L numbers that are on accrual basis. You get the tax returns, they show cash basis, and the numbers look completely shitty. There are two other veterans I'm not working with directly, but I was talking with them on a deal that they'd run by Bruce Marks that he kind of subtweeted about, where they basically were under LOI to buy a company. P&Ls look phenomenal. Tax returns are cash basis. And there's just a huge variance of difference there. So that's one of the best practice items I tell people is find out are taxes and P&Ls in the same accounting method. And as far as kind of pre-LOI financial due diligence, a lot of the time these brokers, to their benefit, because they want to protect the seller's privacy and socials and EINs, won't give you the tax returns until you're under LOI. What I tell searchers is ask the seller or the seller broker, because that's who you'd be in communication with, is it possible to get the first page of the tax return, so the 1120 or 1120S typically, with the EIN number redacted, so that you can match up the income and the expenses on the taxes with what's on the P&L statements? Can you also get your hands on the fifth page, which is the M1, M2 net reconciliation page? Because that has the net income figure that the banks will underwrite off of. And then lastly, try to get your hands on the other deductions page with the EIN number blacked out, because for a bank to count something in the add backs in the SIM, in the add backs that they underwrite on, they have to be able to correlate what's in the SIM with what's in the taxes. So let's say hypothetically that the broker in the SIM has charitable deductions as an add back on, like, in the broker listing. You have to be able to tie that to the taxes. So if you get your hands on the other deduction schedule, there should be a line item where it says charitable contributions or vacation or things like that. It basically itemizes out everything that's an expense that's not on the first page of the tax return. That helps. And that's one way that you can save yourself a major headache. And then another thing too, just have more, maybe this falls more to the financial due diligence category than SBA financing, albeit they both go together, is sometimes on the add backs in the SIM, when the broker's adding back the seller's salary, they aren't just adding back their W-2 comp, they're adding back the distributions that the seller is pulling off the balance sheet. And so you can't, SBA lending, you cannot add back a distribution for owner's comp, because that's money being pulled out of retained earnings. That's not, it's not a valid add back. So just another thing to flag.
That's great. Very, very, very helpful. All right. Any other questions before? I think we're getting right to the 8:15 mark. You know, I'd probably talk your ear off, Matthias.
Yeah. Ask anything and everything. I don't want to be useless here. Appreciate you guys having me.
No, appreciate your time. I guess what are you kind of seeing trends in the space right now? I know there's a lot of, talks about, I don't know, I mean, it's more macroeconomics, but I'm just curious kind of what you think or what you project or how you feel like banks are behaving moving forward. Election year, all the things.
Yeah.
Are you seeing things more difficult for searchers to get good financing terms, or are you finding ways around that? I'd just love to get your insights.
Yeah, so like I guess a couple of random observations I have is some banks are becoming more conservative from a DSCR standpoint. So like our friend Bruce Marks at First Bank of the Lake, I was talking about a couple of weeks ago. His bank now, they used to only require 1.25 DSCR for the last year, and now they're requiring it for the 2 prior years, because a lot of these businesses, brokers are pricing them off of one good solid year of earnings, and basically they aren't taking into consideration the weighted average to determine, is the last year actually normal, or what is actually normalized earnings for this business. So some banks, including that bank as well as others, are tightening up on the DSCR, really wanting to see that their requirement was met for the last 2 years. And there are a few different banks I'm seeing that with. Other than that, I would say a lot of banks I work with are drilling more down into the management and transferable, kind of having led people experience part of business ownership. So if you're coming from the military, if you've led teams and you've led people and you can articulate that to the bank, that's your benefit. Lots of people come from individual contributor type roles. So they may have been a consultant or an analyst or something of that nature. And I think what's going on is some banks have realized that taking your first foray or rodeo in business ownership, when you're taking a personally guaranteed SBA loan at 75 to 80% or higher leverage, is not the best proposition for you and or for the bank collectively. So that's another observation I have, is the management experience is getting a lot more drilled down into. Other than that, banks are looking a lot at post-close liquidity of the buyer group. So some of the more conservative banks, I guess just cherry picking one data point, Huntington, they really want to see 10% collective liquidity post-closing based on the loan amount amongst those that are in the buyer group. Other banks, it's lesser, and it's very much situationally dependent. But what I tell people, and it's a conversation I'm having a lot more now than ever before, Charlie, is if you have $100,000 on your personal financial statement that you're planning to use to buy a business, you should not be planning to put all of that in for the down payment, which seems obvious, but some people don't think that way. Maybe 75,000 of that should go towards the down payment, and then you have 25,000 left post acquisition to cover personal expenses and potential bumps in the road. But that's something a lot, or more than ever before, banks are drilling into now, is post-close liquidity, transferable management experience, or leading people, and then also the DSCR, just seeing that it's actually stabilized over prior time periods. That helps.
Yeah, no, that's super informative. Thanks so much. I know you're seeing a ton of deals and have your pulse on kind of the market, and so that's terrific. All right, I think we're past time, so just want to thank you again, Matthias, for your time and all these insights. It's been a really great discussion. I'm definitely going to share all these great ways to connect with you. Really recommend folks, even if you're not going to directly work with Matthias, just the knowledge that you're sharing via Twitter, LinkedIn, et cetera, is just terrific, and what you do for the community is so well appreciated, and